Hello, dear viewers, and welcome back to our commentary on the global economic circus. Yes, my friends, it's another day, another headache, another deep dive into how the economic policies strangle productivity while claiming to save us from impending doom. Tonight, we dive into one of the hottest topics burning up the financial headlines, gold. Specifically, let's explore how gold is reacting to central bank policy decisions, FX volatility, and, of course, government mishandling that's helping to create this economic torrential downpour. Now, on to the fun part, tearing apart, piece by piece, the irony of financial management by major central banks around the world, and understanding why our good old friend gold is once again looking like the smart place to be. Before we really dig into the meat of today's economic failures, policies, let's talk about the recent headlines that center around the precious metal that's saved humanity in times of avoidable crises for millennia, gold. Holding steady at around $2,650 an ounce, gold has persistently shown why it remains a favorite fallback option, especially when central bankers, the so-called best minds in the room, are indecisive, or worse, wrong, about the steps we need to take for economic security. Gold, which doesn't pay interest, mind you, is still outshining nearly all financial instruments. Why? Central banks worldwide are almost fully pricing in rate cuts, particularly with the Federal Reserve inching toward a quarter-point pivot. Traders are wary, investors skeptical, yet gold continues to edge higher, signaling where the real hedge against crumbling monetary confidence lies. As the Fed prepares to finalize its last rate decision of the year, followed swiftly by announcements from Japan and the UK, investors are stuck in anticipation mode. We're here to unpack what's really going on. Let's start with the Federal Reserve, the grandmaster of market schizophrenia. Everyone's watching as they make their final interest rate decision of 2024. Now, I want you to keep something in mind. The Fed is in a no-win situation. If they raise rates, the burden on borrowers and businesses becomes too heavy. If they cut rates, they risk stoking inflation once again. The market seems pretty confident that we'll see a quarter-point rate cut, but really, what does that signify? The Fed has hiked aggressively since 2022 to stave off inflation, but now they're softening their stance. Why? Mixed data gives us part of the answer. While services are apparently expanding at breakneck speed, the fastest pace since October 2021, other indicators are flashing red. For example, New York's manufacturing activity has nosedived, clocking its steepest decline since May of last year. Pause for dramatic effect, folks, this is the kind of inconsistent data that keeps central bankers up at night. The reality is, the markets are struggling to determine whether the global economy is overheating or in free fall. And let's face it, the central banks have been less than convincing with their actions. Gold, in contrast, it's steady. Why? Well, because gold doesn't care what Jerome Powell's next move is. It retains intrinsic value, regardless of whether fundamentally flawed interest rate policies send the dollar spinning into a tailspin. Next, we pivot to Japan and the UK. Both of these countries are similarly teetering on the edge of rate manipulation-induced chaos. In Japan, the Bank of Japan, BOJ, has kept interest rates near zero for years and toyed with bond yield control, because apparently, no yield is better than a small positive one, leading to a debt-to-GDP ratio that gives new meaning to the word unsustainable. When markets sense fragility in currency or inflation levels, gold thrives. Over in the UK, things aren't much better. Persistent inflation, running high by Western standards, means rate cuts might seem attractive. However, if the bow slashes rates too quickly, they risk stoking even more inflation in 2025, especially with Brexit disruptions still sending shockwaves through trade and labor markets. Let's not forget the real story on gold's impressive gain, up 29% this year alone. But why is that, you ask? Aren't we supposed to be in a period where inflation is being contained thanks to hawkish central banks? Well folks, here's the unvarnished truth, much of that inflation wasn't contained. In fact, the past 2 years have seen inflation subtly eating away at consumer and business confidence across the globe. In the US alone, inflation reached multi-decade highs, fueled by irresponsible money printing, aka quantitative easing, during the COVID era. Inflation is stealthily re-emerging in the economy, in commodities, wages, and largely in sectors like housing and energy. While the Fed and other central banks have patted themselves on the back for slowing down inflation, the reality on the ground shows otherwise. Every time inflation surged, gold followed suit. And it's not just speculative traders driving gold's demand. Let's talk about central banks themselves. These are supposedly the same institutions that manage fiat currency. They've been on a gold buying spree. The World Gold Council reported that central banks bought more gold in the first half of 2024 than in any period over the last decade. India, for instance, topped the charts with a record surge in gold imports last month, after cutting customs levies. Fear and mistrust in the global financial system are pushing the very architects of modern fiat currencies into the arms of gold. The world is once again chaotic. Geopolitical tensions, erratic interest rates, commodity price volatility, the perfect ingredients for another financial storm. And guess what? During times of international tension and financial uncertainty, gold picks up steam. Look at the Middle East situation, Europe's energy crises, and the ongoing friction between China and the Western economies. In a world where liquidity is drying up and currencies are increasingly volatile, gold becomes the ultimate hedge. Eager to preserve their wealth, both institutional and individual investors alike see gold as a safeguard against the pending financial storms. Instead of absorbing empty promises of long-term stability from central bankers, they're moving into assets that have historically proven their worth. Now, to anyone who was paying attention during the last global financial crisis in 2008, this probably feels like déjà vu. Safe haven demand, combined with erratic and ultimately flawed central bank policies trying to balance inflation and growth, pushed gold to record highs back then. Don't be shocked if we're headed for a similar trajectory. Now, what about the US dollar? Everyone knows gold trades inversely with the dollar. When the dollar rises, gold falls and vice versa. But today, with the Bloomberg Dollar Spot Index showing minor fluctuations, gold still holds strong. Could it be, dear viewers, that the dollar's decade-long reign as the ultimate safe haven asset is being dethroned by the one enduring constant, gold? With global de-dollarization narratives gathering steam, various economies, including China, Russia, and even Saudi Arabia, are looking to diversify away from the greenback. Although we're far from the collapse of the dollar, as it remains the world's default reserve currency, the cracks are starting to show. More countries are trading in their dollars for commodities and alternative stores of value, gold being the most obvious one. So, what are we to conclude from all of this? Gold remains rock steady, not because everything is fine, but because everything isn't fine. To the untrained eye, it might look like gold is performing abnormally well this year, but to everyone tuned into the absurdities of the global financial system, it's blatantly clear, there could be no better time for gold to shine. Lower interest rates, the ongoing geopolitical malaise, inflationary bubbles, and central bank incompetence together form the perfect storm for continued bullish prospects in gold. As we look to 2025, expect more of the same old dysfunction from policymakers, which will almost certainly push gold higher. There is every reason to believe that gold could climb even higher in 2025, especially as the global economic imbalances continue to rise. The fragile state of many major economies, combined with risky financial engineering from central banks, makes the outlook for fiat currencies bleak. So, dear friends, as central banks fumble about trying to manage this mess of their own making, gold, as always, stays the course. The more our governments and financial policymakers fail to take accountability for their actions, whether it's frivolous rate cuts, exploding debt-to-GDP ratios, or geopolitical instability, the more investors will flock to gold. Don't be fooled by the talking heads and the confident press conferences that assure you they have everything under control. Their control, as always, is a facade. Whether or not they act on cutting rates or continue printing money, the fundamentals dictate that gold will continue to be the hedge, the safe haven, and ultimately, the winner in this economic game of smoke and mirrors. Thank you for tuning in today, and remember, while central banks might rise and fall, gold, my friends, is eternal. Stay sharp out there till next time.